Hi, and thanks for joining us for our Ag Business Climate Outlook for 2017 webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me for our webinar this morning are my colleagues, Dr. Chris Hurt, Professor and Extension Economist in the Department of Agricultural Economics. And also joining us is Michael Langemeyer, who's also a professor and the Associate Director of the Center for Commercial Agriculture as well. So we appreciate you spending some time with us. We thought it would be useful to take a little longer term look at what the outlook is for agriculture here in 2017 and maybe just a little bit beyond 2017 as you're formulating some of your business plans for the year ahead and maybe the next several years. So with that, Chris, I thought it'd be useful to maybe start off with kind of a longer term perspective, and you put together a chart of nearby monthly corn futures that goes back to 2002. Talk us through that chart a little bit, because I think there's a lot of information on there.
Well, I think there is, and again, one of the things that we have to remember is that we started into the boom and now moderation period of agriculture in the fall of 2006. Now, this 15-year chart picks up all of this activity over this last decade, so we want to kind of see the lessons, I guess, that we can learn from this longer term perspective. Again, I've drawn a line at $3 on the nearby corn futures. And what we see is that in the last 10 years, that $3 level has basically been a floor. It has been a support level. We've gotten down a number of times to the $3 nearby futures, but the market's always bounced off of that. As we span back that 5 years on the left-hand side, we see that $3 was more or less not an upper bound, but it was a level when corn futures got to be $3. That generally that was a high price for corn at that time, and mostly in that 5-year period, corn traded between around $2 and $3 a bushel on the lead contract. So as we look at the scenario we're in now, we see the 2008 time period, and I'm thinking about the last 10 years, the boom moderation period. Let's look around 2008, and you see nearby futures going up to $7.50. That was the first world food crisis, shortage of food, and talk about food versus fuel, etc. We had the recession in 2008, late 2008, 2009, and you see poor economic growth in the United States really changed prices quickly. And then the second crisis on food on out into the 11 and 12 time period, with 12 being not only tight stocks, but then we had the drought, major drought in 2012. So that moderation then to lower prices really came in the late in 13 and then on into the 14 crop, and we've continued to see that. So this boom moderation period, one of the good things we can see in corn is that we touched down to the $3 level on the nearby futures. That was last August and September, and then we've rallied off of that. So the positive is that buyers came into that market when we got down in the low $3 range. So that is a positive. If we were looking at a similar wheat chart, we would see wheat have penetrated below the 10-year lows back in August and September and has basically stayed there. So I think that tells us that wheat is the product that really is the lowest price. Corn is the second lowest, and we don't have the soybean chart, but it actually looks a little friendlier, particularly since we lost about 220 million bushels of bean production in South America back in the spring of 2016. So these a lot of change. We know the boom that came in prices really increased revenues, good profitability, and then cost went up with that. And now we're dealing on the other side of that. Prices are insufficient to really cover all the costs that we have out there.
So Chris, as you look at the chart, you view the $3 mark, that red line that you've drawn on the chart, as kind of a bottom for the corn market?
I think you view it as a bottom and really a heavy test of that back in August and September. No producers want to be talking about $3 futures on corn, but again, it's a little bit comforting that range we're in up to, I think, about 440, and the 440 would be back in the spring of 2016, as we talked about. Now, again, that was a weather disruption, but this says we're more bounded by something in the $3 range up to maybe 440 a bushel at this point, with the 440s coming on some kind of weather disruption at some point. And so, we'll look on into the future of what this means, but these are the huge variability that we have seen, obviously, and the reality that we face now.
And I think maybe extending beyond that a little bit, I think we're going to argue as we progress through the webinar today that although we might see corn futures touch $3 again, we don't expect corn to stay at that level for any length of time.
Well, I think that's right. Another thing that would be, I think, of significance, we didn't mention the beans, but that longer term average the last 10 years have been about $8.50 on nearby bean futures. Now we're above that at this point, but I think that's a reminder that if we get shifting into beans, we get a good bean crop out of South America, the downside risk on beans is probably to $8.50 on futures. And of course, that's much different than $9.50 to $10 prices we've been looking at most recently.
All right, so we'll come back and revisit this later, but I think the key point here is that floor at $3,
right,
maybe a bit of a trading range between $3 and $4.50, and I think later on we're going to probably argue that the challenge for a lot of us is to think about how do we reduce our cost to get them in line with
the realities of the price we have. And again, we'll mention, look at 2008 as well as that 2011 and 12 time period. That will be of significance as we move forward.
Let's take a look at another monthly futures, and this time it's the dollar index. And I think, Chris, there's a long-term perspective again going back to 2002, but we've got this up here because of the importance of trade to U.S. agriculture.
That's right, and we looked at 2008 in terms of the value of corn and then on into 11 and 12. And what we notice here is the inverse relationship. The dollar was very weak. This is nearby futures on the U.S. Dollar index. A weak dollar is generally good for agriculture. A weak dollar means that our foreign buyers' currency is strong, buys a lot in terms of the United States products that we have. So that is reflected in the 2008 and again 11 and 12. And we not only had tight stocks at that time, but we had a very weak dollar. And that helped really propel those prices of corn, soybeans, and wheat to their really record highs. Now, obviously, the current time period over on the right-hand side looks much different. We've had a very strong dollar in 15 and 16, and that dollar in the last few months, November, the last three entries there, November, December, and January, going to 13-year highs. And we have the face of Donald Trump on this the last 3 months. And of course, why are we talking about the new administration? Because with the advent of the new administration, Wall Street largely decided one of the first things that the new administration was going to do would be some kind of an economic stimulus package. Now again, the anticipation is that that will have tax cuts of some kind. The exact measure of those or how those will be implemented still to be determined, but tax cuts would be stimulatory, especially if it's middle income tax cuts and lower income tax cuts to consumption, and consumption's a major part of our economy. Second part of that, probably infrastructure development. So infrastructure spending from the federal government probably would require some of the budget go into that infrastructure spending, stimulation of jobs. And the third part of that is reduction of regulations. So we've seen sectors like the financial sector especially have very robust increases in their stock prices with anticipation that Dodd-Frank will be looked at, will be some of the regulations for the banking sector will be reduced. Now that all sounds good. That will help stimulate the U.S. economy. But when the strength of the stock market and the anticipation of a stronger U.S. economy is reflected in the dollar, that bids up the value of the dollar. So as we said, a low value dollar tends to help us sell more product of agriculture goods out in the world market. The opposite is true, and that is when we have this strength of the dollar, these are really headwinds for U.S. agriculture selling into the world market. And we've broken that out a little bit more by country. And two countries that President-elect Trump has really talked negatively about with regard to the U.S. economy. And I think everybody can quickly come up with those two countries. China is one of those, and Mexico would be the second one. And as we think about China and Mexico, those are two really important countries to us in U.S. agriculture and selling goods overseas. China is our number one customer in terms of the total dollars of sales. Mexico has been our number 3 customer, China, Canada, and then Mexico most recently. And Mexico has had a special place, it seems, in President-elect Donald Trump's discussions. We continue to see that most recently with the announcement of Ford stopping building a plant in Mexico and instead going to replace that in Michigan. So the world has really looked at Mexico as a place to be very careful about investing with this new relationship between the new administration and Mexico. And since the election, the Mexican peso has dropped 15% in buying power. Now, I made a list of how important Mexico is to Indiana agriculture. They're our number 1 corn buyer from the United States. They're number 1 soybean meal, soybean oil, high fructose corn syrup sweeteners, live animals, breeding stock, dairy products, the milk sector, the poultry products, and eggs, number 1. They're number 2, soybeans and wheat, distillers grains, beef and pork. So that just pretty well covers Midwest agriculture in terms of their importance, and the buying power of their currency has dropped 15% in less than 2 months. So I think the point of this is to say that these macroeconomics seem to be somewhat stimulative to the domestic market. On the other hand, our worries in agriculture really revolve around the strength of the dollar through this next year. And secondly, about trade disputes. Will we get into trade disputes, particularly with China and Mexico? And obviously, anything that disrupts trade or could slow trade down for our agricultural sales would be a real concern in 17 and 2018.
Yeah, so Chris, really a couple of things jump out at me when I look at the chart. And one, of course, is the fact that the dollar was strengthening for some time before the election. But the second thing, which maybe is a little more subtle, is the idea that the dollar index, it matters a lot how you index the dollar.
Right.
And the dollar index futures are keyed off of not necessarily key countries that we do a lot of agricultural trade with, but rather broader measures of trade. And so looking at those individual countries, as you did in that chart in the upper corner, is really important to look at the individual countries like Mexico, Japan, and China are some of those key customers. And the big change really, as you pointed out, since the election has been number 1 Mexico and really number 2 Japan. Those are big changes in a very short span of time.
Japan's now our number 4 trade destination for ag goods, so it's very important. We put Argentina on there, and they're competitors. So when their currency drops, it makes it easier for them to sell beans, as an example, soybeans to China. So we see this pretty much across the board that so far the exchange rate impact has been a bit on the negative side for U.S. agriculture. And the real worry is the longer term, will we get into trade disputes?
That's right. So that's one of our big concerns in agriculture across the board. And we've talked mostly here about the grain side, but also the meat exports are pretty important as well. And those have become so much more important to the meats than they were just a decade or 2 ago, right? So
and we've probably got some balance there. A stronger U.S. economy would help the meats. The stronger dollar would hurt exports on meat. So I think we've got, it's talked about the Trump bump in terms of the stock market here. The reality, we'll have to see if that follows through in reality.
Yeah.
This is the anticipation that we're going to see a better U.S. economy.
Let's take a look at interest rates, because those have changed quite a bit recently as well. And you've got Treasury rates since the election, both on the chart as well as in the table, which really kind of spells it out for us. And you can see the yield curves changed, right? And the absolute levels have changed as well.
That's right. And again, the yield curve, just looking at the maturities down on the bottom scale there from 3-month to 20 years in terms of U.S. Treasuries, and what is the interest rate in those. The blue line being on election day, and then the orange line this week, what are those interest rates now. And so that biggest spread is in that 5 to 7 to 10-year category, where those rates have gone up the most. They've gone up about 60 basis points, or about 0.6%. They had been stronger than that. They had been on up 7 to 0.8% that they had raised. So moderated just a little bit here in 2017. But as we look at interest rates, what does that mean for U.S. agriculture? Well, rising interest rates, I think, generally are on the negative side for U.S. agriculture. Why is that? Higher interest rates, at least relative to interest rates in other countries, tends to drive the dollar higher. So as we're looking at the U.S. now in a situation where we're probably going to see more interest rate increase here than in other countries, that's going to continue to keep that dollar buoyant to the upside. Higher interest rates, Michael, in terms of the farm finances, increases the cost a little bit for borrowing debt. That would tend to reduce profitability somewhat, depending on how much interest rates move up. And at least in direction, higher interest rates would tend to have some negative impact on land values. So I think the macro side of things, we've got an encouraging U.S. economy that looks stronger, a little bit higher growth rate. The counter to that is that while fiscal policy in terms of the federal government seems stimulative, the Fed at this point is tapping on the brakes to slow the economy down and is concerned about putting more inflation into the economy. And so the initial burst in early 17 probably is a little bit of strength, but then we'll have to see if we don't slow that enthusiasm down as we get deeper into 2017. So I think, again, the macro side is not necessarily really encouraging that that's going to help us in the agricultural sector pull out more of the downturn we're in.
From a management perspective, Chris, I think we've done these Outlook webinars at the start of the year now for several years in a row. And one of our management recommendations every year has been to lock in interest rates because we were at or near historic lows.
Yeah, so don't change now. You know, one of these years will be right.
So, you know, it looks like we finally have seen those rates start to move up. But I think from a management perspective, I would still argue, and I want to see if you agree, that we would probably recommend, if you haven't done so, locking in rates even at these levels, right? Rates have gone up significantly in the last 2 months. However, when you look at it from a long-term perspective, these are still pretty attractive long-term rates. And if you haven't restructured your debt, if you maybe ignored our previous advice or had some other considerations, this is still an opportune time to do so. So it's still an opportunity to lock in rates that from a long-term historical perspective look pretty attractive. And looking ahead the next couple of years, odds would favor those rates continuing to move higher.
Well, I think that's right. And one of the things we do with fixed rates is we get certainty. And, you know, we are in a period of time where certainty has some value to it, I think, at this point, to know what your rates are going to be.
All right, so let's take a look at some prices. And people want to know, where are grain prices headed? You've got some history on there. These are the market year averages that USDA uses.
U.S. average price received, that's correct. And 12, we start at the high. And of course, I guess it's going to be downhill if you say that's the high. But you know, near $7 corn. Remember, 12 was also the drought year. So not only did we have the tight stocks, but we also had the drought. So an exceptional year, obviously, but around $7 corn. And these span out to 2019 crop because people need to make decisions about longer term, the next several years, I think. The lowest of the prices, at least for corn, are this crop 2016 we're marketing now. USDA is at $3.35 a bushel on that crop. And then going out 17, 18, 19, all we're doing is looking at futures prices currently and adjusting those to a U.S. average price. Now that's not a perfect prediction. Obviously futures aren't perfect predictors, but at least it is a market determined base. And what that shows is some healthy increases in corn prices, 40-cent higher prices for the 17 crop, getting up then in 18 and 19 back towards the $4 mark. So I think that's encouraging, at least from direction. That's the right way to head to try to reduce these losses we're in. Let's look at wheat at the very bottom, over on the left-hand side, near $8 wheat average prices at the record high. Then those lows for the boom moderation period coming with the 16 crop, we're continuing to market at $3.70. And same pattern in terms of the wheat prices for 17, 18, and 19, with substantial increases, especially as we get into 18 and 19. Now, how are we going to get higher prices on corn and wheat? Well, the thought is we're going to reduce acreage on corn and wheat. And why would farmers reduce acreage? Because prices are sending signals that returns will be low for wheat and corn. And if they reduce wheat and corn acreage, where does that acreage go? Obviously, soybeans is where that goes. So what we see in the soybean pattern is while making some very low prices in 16, those are not as low as we saw in 15 because of the South American loss of production in the spring of 2016. And so we're a bit, relative speaking, short on beans in relationship to world corn and world wheat. So that reflects in 17 a little higher price. Futures are still a little higher priced for the 17 crop. Our guess is we'll be back more like to $9 beans for 17, but these are current futures. Then in 18 and 19 the futures market reflects dropping back into the lower $9 on soybeans.
So Chris, that kind of gives us some basis for why we're talking about targets for production cost. If you look at the corn side, we're going to suggest that maybe a target should be somewhere in the vicinity of that $4 a bushel. Soybeans, we're going to suggest $10 a bushel or less, certainly less if you can get it down there, but certainly nothing above $10 a bushel should be a target for production cost. Right. And looking at wheat, 4-ish, right, would be
yeah, maybe a dream to get wheat down that low, but and I think another point is, this doesn't get us to $4 corn until 2019. So that's still several crop years away. And if our cost structure, if we were down around 4, then we still have some negatives to go, some couple more years of negatives. So I commonly get asked, well, when's corn going to get back to $4? And people are generally thinking, I'm going to say April or May this spring. And when I say 2019, they seem discouraged. Now, it's not to say we can't see some seasonal spikes or some weather problem spikes, but at least I think this is a good set of numbers to help us think about. No quick recovery, but some recovery as we go into especially 18 and 19.
Well, and when you use these, that's a good point with respect to the spikes. When you use market year average prices, as we're doing here, right, it gives you a perspective about the profitability of the entire industry.
Right.
It doesn't say that there might not be some opportunities to market within that are higher than those levels.
That's correct.
But it does give you an idea as to what the industry is facing in the aggregate.
And again, Eastern Corn Belt, we're talking about corn prices getting up in the cash prices, $3.70, $3.80 into the spring. So with storage, that's getting back closer to that $4 mark. We ran through those prices because we wanted to get a perspective of revenues and cost. So that's what we've done with this visual. And again, this starts 2005 on the left. 2006 is when revenues really started to go up. That is, prices started to move up. Revenues move immediately as prices go up. It spans through the 2019 crop. And I think a couple of the things you can get out of this. Number one, when you are in a boom period of prices, prices adjust upward very quickly or they adjust downward very quickly. Cost, on the other hand, take longer to build those higher prices into the cost structure. So the blue line is total cost of production for a 50-50 corn soybean farm on average quality land here in Indiana. The red line, revenues, that's the market. It includes an estimate of government program payments and crop insurance. And what we see is when the red line's way above the blue line on the left side, those we call economic profits. They're profits above all cost of production. We've put cash rent for every acre. We've put family living expense for every acre. We have depreciation on machinery for every acre, and there's still $100 or $150 left over after covering all those resources. We get into 13 and especially 2014, and that's where we get these big drops in prices. Prices adjust quickly at a time when our costs have been built up to very high levels, the blue line, and so this gets us into the negative returns time period, or revenues are below that total cost of production. The dotted line shows where we're at this point, and I think we can recognize margins staying negative for 17, 18, 19 on this measure, but improving, as we said, in 18 and 19 revenues a little bit, with the blue line, cost of production, continuing to come down a little bit, continuing to work on cost of production. So I think that's some important lessons right now. Revenues, we can't say markets are optimistic. We're going to suddenly pop back to $4.50 corn as an example. And if we stay where we're at on corn in terms of the numbers we just looked at, moving back towards $4, we're going to have to continue to work on our cost structure.
So Chris, as I look at this chart, there's a couple of things on here that are a little bit unusual from a really long-term perspective, and I mean longer than what we've got on the chart. And that is that normally we would expect to see the red line and the blue line very close together. The fact that we had a period of time when the red line, the revenues were substantially higher than the cost was unusual.
Yeah.
And the large losses we've been experiencing recently are also unusual.
That's correct.
So we're struggling to get back to something more closely approximating equilibrium. Right. And what we're arguing here is that the way we're going to do it over the next several years is to continue to push down those cost of production. We're not expecting dramatic changes or improvements on the revenue side, but we are expecting to see longer term this ongoing adjustment process on the cost side. Right, Michael?
Yes, and let's talk a little bit about the cost reduction that we've already seen, because it's rather substantial. If you compare 2013 to 2016, Chris, that's $75 per acre.
Very important.
And the three primary sources there, two more important than the third. Cash rent has come down about 12% in Indiana since the peak, but also fertilizer prices. We've talked about that in previous webinars. They're down 20 to 25% from what they were a year to 18 months ago, and so that's certainly helped. The third one is a little smaller cost item, but it's still important. Fuel costs are down quite a bit compared to what they were compared to 2013 when we look at 2016. As we look at forward there, cost reductions are going to be a little tougher. We think we still have some room to maybe negotiate cash rents a little bit lower, but then it gets a little tougher once you get past cash rent. But that's the challenge that we're in. Looking at the other costs, is there some room to reduce fertilizer costs? Is there some room to reduce seed costs? Those are important questions that we need to ask, because as this chart clearly shows, we have to take some more cost out of our budgets.
And I think we've argued in the past and going to argue again here today is that you need to look at every aspect of your operation, because there's, as you pointed out, there's not a single cost. I think some people think it's all going to come out of cash rent. We don't think that's likely. We think we are going to see significant downward adjustment in cash rent the next 2, 3, perhaps even 4 years based on history. And you've done a lot of work on that with respect to longer term adjustments in the cash rental market, but it's not all going to be in the cash rent side.
Certainly not.
Okay. So Chris, I think you've taken the numbers that are on this chart and expressed them in a little different format, maybe a little easier to see what's going on.
Right. This spans from 2005 on the left through 2019. These are in essence just the residuals from revenue. The blue bars, revenues were higher than total cost. So again, we call that economic profits. If you were in the farming business, you got returns that were above normal rate of return for the resources you had employed. We just kind of look at the middle of the graph there, 2010 through 2013. On these average Indiana acres, we had a total of about $429 on budgeting in this manner. And interestingly, then we look at the reds over on the right-hand side from 2014 actually through 2019, and those are about the same amount of loss. And, you know, as we're talking about a boom and a moderation, the boom, the excess profitability is roughly offset here by a loss period. And we often see this in adjustment processes in markets, that prices or other adjustment mechanisms swing so far in one direction, then swing so far in the other direction. Another point of this is to say that how we get through, how individual families get through this downturn has a lot to do with what did they do with the excess profitability during those good times. And the vast majority of farm families invested that pretty well. They didn't just throw that money away. They worked on their financial positions. They invested in machinery. They invested in grain systems. They improved the quality of their land with drainage, etc. So that's really going to help them to weather this time period. But it also reminds us that if we're feeling some financial stress at this point or concern, we've got a couple more years, it looks like, of where we may have these negatives. And those are something that individual farm families need to be thinking about, concerned about, and working with their lender to think how they're going to work through this time period.
Let's look at 2016 a little deeper there. 2016 looks a little bit odd when you look at 2015 and 2017. We look at some improvement there. Well, there's a couple things going on there, Chris. At least I think. Correct me if I'm wrong. I think Ark County program payments helped us in 2016. They probably aren't going to help us as much as we move forward, and so that's one of the items. I think the other one is the strong yields, particularly for soybeans. I mean, soybean yields 15% above trend, something like that in Indiana. And so that's probably $50, $60 with those two items. And so that it would be much more of a gradual reduction in losses as we move forward if it wouldn't have been for strong Ark County payments and strong yields in 2016.
So that's a good point, Michael. As you look at that chart for 2017, and we're suggesting a larger loss than
that's
16.
Trend yield. We use trend yield.
It's a return going to trend yields.
And lower Ark County payments.
Which I think from a budget standpoint makes a lot of sense this time of year. You don't want to bank on yields being 10 or 15% above normal or trend. So a good point.
Those are good points. Just throw out in 15, those big losses in 15, that was 150 bushel corn in Indiana for an average, and those low yields were a major contributor to those low returns.
Yeah, and it looks even worse if we split out northern Indiana. It would look even worse in 2015. Right.
So Chris, you've taken the numbers on this chart and then translated those into what does that mean for a fairly typical 2,000-acre operation here in Indiana?
And we're thinking a cash rent tenant really has all of these costs that we're talking about when we put all costs together. They have to pay cash rent for their acres, and especially a young family that has family living expenses and they're buying their machinery line. So we just start with an illustration of a 2,000-acre cash rent tenant that at the end of the boom had $500,000 of working capital built up, current assets in excess of current liabilities, strong ability to meet their financial obligations as they came forward. And then we're just taking those losses year by year as we chart it out. And what we see in 2016, that $500,000 of strong working capital position is largely eroded. They're down to a point where they're having trouble with liquidity, and liquidity is meeting their financial obligations as they come due. And then looking on into the 17, 18, and 19 crops, with some more negatives coming at them. So the red here on the 17, 18, 19 is an inability to meet their obligations. So probably this family is going to have to find other sources of revenue, other sources of cash, or work with their lender, and hopefully they'll be able to work with the lender. Now again, this is pretty dramatic when you put it on a family basis, but that's that $430 an acre we were talking about of total losses multiplied times 2,000 acres, and that gets you $860,000 of erosion of your financial capital, working capital situation.
And of course, we've been talking about this for a couple of years now with respect to the need to try and preserve working capital, and this chart really just illustrates that.
And again, this doesn't say for everybody. I think we want to look at broader than just an illustration, and to give us an idea of what is going on out there.
So, Michael, you've pulled together some data from the Federal Reserve District, 7th Federal Reserve up in Chicago.
Yeah, let's explain what we got here a little bit so we don't get too excited here. But this is a diffusion index, and so basically what the Federal Reserve Bank of Chicago does, and as other Federal Reserve banks also do this for agriculture, is they ask lenders whether they think loan repayment rates have improved or diminished in the last quarter. And obviously, the last several quarters, loan repayment rates have diminished. And so that's what this chart is clearly showing. This is through the third quarter of 2016, and so the ability to make these loan payments, it's very similar to what we showed in the previous chart, has really increased. We really having more difficulty making these payments, compared to what we did even last year.
Yeah. So the chart illustrates the strength we were seeing back when prices were really strong. And it shows this erosion that really Chris was depicting on the previous slide as well, and suggests that in fact we do have some people that are struggling out there, right?
And this, of course, isn't the first time over a very long period of time that we've seen some struggles, but it does put in perspective what we're facing today is as severe in many cases from a cash flow standpoint, not from a debt standpoint, but from a cash flow standpoint of what we saw during parts of the 1980s and around the late 1990s.
So you've also taken a look at some data from the University of Illinois' Farm Business Association data.
So this is the summary from the Illinois FBFM, so we make sure to we get the proper source here, citation. If you look at benchmarks, for example, we typically think of a current ratio above 2 as something that's good. That gives us plenty of cushion there if prices decline or we have relatively low yields, or a working capital to value of farm production ratio of 35%. Obviously, the upper quartile at the end of 2015 had very, very strong liquidity compared to these benchmarks. The medium wasn't bad. You're getting a little bit tight there from a current ratio standpoint, but still reflects the fact that in median farm, median there, are kind of an average situation, we were able to meet our liquidity needs. It's that lower quartile that really concerns us here. And that lower quartile really has their back up against the wall and really doesn't have very much wiggle room. You look at a very low current ratio there. A ratio of 1 means that you can just cover your current loan, current debt obligations. A working capital to value farm production ratio of 10%, same thing. You just barely cover your current debt obligations. And so those group of people are in a very tough situation.
Well, and I think your point has been that if anything goes wrong, cut back on yields, prices maybe a little bit lower than what we were projecting. Anything like that causes those farms to immediately have a severe cash crunch.
And when we look at the average farm, we talk about things like negotiate cash rent, make sure you're not spending money on machinery. Be very careful when you're buying machinery. This lower quartile, it's a more severe advice than what we've been talking about from the average. They'd have to be very, very careful with the use of crop insurance, use of marketing contracts, anything they can do to reduce the uncertainty.
And that's the bottom 25%. If you drop to the bottom 10%, you begin to think there could be some really concerns.
And this is the end of 2015. My guess is there's going to be further erosion in 2016.
We're a year later than that.
Despite the fact that we had strong yields, there's still going to be some further erosion.
Yeah, so as you think about what that means here in 2017 and 2018, it suggests that some people are going to be in a tough enough situation that they're probably going to wind up exiting the industry.
That and we don't. I'm not illustrating here the debt to asset ratio. Some of these people in the lower quartile certainly have room to maybe put some debt on land.
Right.
Restructure their debt. So there's probably some ability to do that, but that group is certainly going to have to strongly consider that as we move into 17.
So you're saying liquidity doesn't mean necessarily that they're going to have to exit?
No, not necessarily.
No.
You've got to look at their solvency.
Right. So let's take a look at the government program. We've alluded to this previously, but I think it's important to maybe spell that out a little more clearly.
Yeah, and the payments in 2014, which we actually received those in the fall of 2015, but that's for the 2014 crop, were quite variable across counties, as this chart illustrates here. I've got counties from different parts of Indiana illustrated here. In 2015, a lot of counties, Elkhart did not, for example, but a lot of counties in Indiana received some very strong payments, Ark County payments for corn, and I'll show the soybean chart next. That really helped. And so that's one of the factors that created a smaller loss than what we thought it might be for 2016, because the 2015 payments were received in October of 2016. The point I want to make here that's very important for the audience is the expected payments in 2016, which will be received in October of 2017, are quite a bit smaller than the 2015 payment. So that's the main point I want to make here. They're also quite variable compared to the 2015 payment. They're going to vary considerably depending on what county you are in Indiana and across the Corn Belt. And so those are two important things to factor in when you're developing your cash flow. Don't expect payments to be near as large as they were this last go around, and you probably don't want to factor in a real high payment because there's quite a bit of uncertainty related to the payment in 2016. Where does the uncertainty occur? We talked about this in a November webinar. Two sources. One is the final county yields will not be published until February, and so it's going to depend on what those final county yields are. It's also, of course, going to depend on the price. If the price is relatively weak, payments will go up. If price is relatively high, payments will be smaller, and so don't count your chickens yet. There's quite a bit of uncertainty here with these Ark County payments. It's also important to point out here, Jim, is with the exception of Elkhart and maybe a few other counties in Indiana, we're really not expecting payments for corn or soybeans for 2017 and 2018 crops.
So I think there's maybe a corollary there, Michael, and that is that when those county yields are published by NASS at the end of February, at that point, it's useful to sit down and do a projection as to what you think your payment is going to be in the fall of 16. Because at that point, you can do a pretty reasonable job of estimating what the payment's going to be. The biggest source of variability going forward, obviously, would simply be the change in prices. Yeah. But because it's a market year average, it's heavily weighted towards the first 5 months of the year.
Yes, it is.
So when you sit down the 1st of March and project a payment for the fall, you won't be perfect, but you can do a pretty reasonable job of generating an expected payment. And that's going to be a useful thing to do for some people this year. And in fact, our colleagues at the University of Illinois at the Farm Doc team make available a spreadsheet that makes it pretty easy to do that.
Yes, very easy to do this. For this particular chart, I probably used an overly optimistic above trend corn yield of 10%. If that would come out to 5%, these numbers would change.
Yeah.
And so, once the February numbers are there, you're going to have a much better estimate of what those possible payments are going to be in the fall of 2017.
And then the other point is to think about, as you think about those out years, and Chris, you had the chart up previously, we really don't think there's going to be any likelihood of any payments in 2018, and the payments for the 2017 crop are likely to be very, very small.
And as I indicate to the audience, you don't want payments in 2017 and 2018, because the way you get payments in 2017 and 2018 is corn drops to 3.
Right.
And so we don't want that scenario.
And that's a function of how those averages are computed, those Olympic averages. All right. A little similar kind of a perspective
Yeah, we've already
on
talked about the
soybeans.
soybeans. The soybeans, we've had received a fairly strong payment for the 2015 crop, which again, we received that payment in October 2016. We're not expecting payments in 16, 17, or 18 for soybeans. And again, the only scenarios where you really get some payments for soybeans is if that price really drops.
So the payments this past October surprised many. They
Yes, it
were
did.
so good. So what are you telling them for next October? Jim said at the end of February you could maybe start doing some estimates.
Well,
What are you-
we looked at some counties for corn, and I've done more counties than just the 5 that I've shown. A corn payment, maybe $30 to $50 would
Okay.
catch a wide spectrum of counties in Indiana.
with nothing on
for corn
soybeans.
and nothing on soybeans.
Okay, versus maybe
Versus
$70
yeah,
on
versus
corn.
a $50 to $70 payment on corn and a $50 to $60 payment on
beans.
soybeans.
So they're going to be less than half,
Yes.
probably, maybe a third,
Yes,
a quarter to
quarter
a
to a
third,
third
Yeah.
when you combine corn and soybeans.
as an early guess.
Yes.
And the soybean is driven so much by the really strong soybean yields we
Yes.
had throughout much of the Corn Belt and especially Indiana. You've taken a look at some costs, we keep alluding to cost and the need to reduce cost of production. So let's walk through those a little bit and see.
What I've done here is I've put together the largest 6 cost items for rotation corn and rotation soybeans on a per bushel basis. We've talked about the importance of looking at these on a per bushel basis because when you look at changing these different input items, we want to make sure that we look at the impact of yield in those decisions. So that's why we put this on a per bushel basis. But if you look at these 6 here, the 3 that I think we still have some room to perhaps reduce: land, that would be your cash rent, very important cost for both corn and soybeans, even more important for soybeans because soybeans doesn't have as high some of these other costs as corn. The other 2 that I think to really focus on here would be seed and fertilizer. Very large cost items, and there's probably some things that we could do when we're to possibly reduce our seed and fertilizer cost per bushel.
Yeah, and I think in a future webinar, we plan to get together with our
Yes.
colleagues from the Department of Agronomy and talk about using some of the research results that they've been working on for many years now with respect to optimizing seed and fertilizer usage that might help reduce those per bushel costs.
Another reason for putting this up there, if you don't have if you haven't calculated these items for your farm, I strongly encourage you to do that because these are just average or budget numbers. These can vary tremendously across farms. In particular, that last one, that labor cost, this is a 3,000 acre farm here, and the labor costs are relatively low for this particular farm. That could be double on a farm that does not have as much labor efficiency as what's built into these numbers.
Good point.
And so please, if you haven't calculated the per bushel cost on these, I would strongly encourage you to do that. Also, Jim, this doesn't include all the cost items, and so the final cost item there is not the break even. It's smaller than the break even because this only includes these 6 cost items.
Yeah, to put that in perspective, I think on the soybean side, you'd be up around 10
Yeah, it's
75
cents to $1 higher on the soybean, and probably another 50 to 60 cents on the corn. And we're going to see these in some charts here. Let's just look at this real quickly, how break-even price does vary across land productivity category. We're certainly much closer to break-even on the high productivity ground. That would be typical of west central and central Indiana, for example, but there would be high productivity ground in other parts of Indiana too, but they would be fairly reflective of those areas of Indiana. Certainly much closer there than we are on average, and in particular we're a long ways from break even on the low productivity. And so this just tells us that we've got a lot of negotiating to do with regard to cash rent on the low land productivity. That really suggests that in this particular chart.
Yeah, you know, Michael, when I looked at this chart, when we were pulling this together, the spread between the low productivity and the high productivity cost of production was
It's
pretty
alarming.
astounding. Yeah, almost $1 a bushel.
Yeah.
I guess, 89 cents a bushel. As you think about that, what does that imply going forward?
a lot of the adjustment has to come from land because low productivity ground, you have to have a certain amount of fertilizer, seed, and some of these other costs just to produce corn and soybeans on low productivity ground. And so, yeah, there's a little room to perhaps reduce those costs, but a lot of the cost reduction for low productivity is going to have to come out of land costs.
Yeah, if we're going to see, stated another way, from a long run perspective, we would expect to see those cost of production values across productivity categories become very close to each other.
Yes, good point.
So it implies that cost of production on corn on the low productivity ground has to come down more rapidly and more aggressively, and a lot of that's going to have to come out of cash rental rates. So we're really arguing that those cash rental rates on the low productivity land are somewhat out of equilibrium relative to the high value, high productivity land right here in much of the Midwest and Indiana. So.
Another point I think is valuable. Can we go back to the corn? On the low productivity soils, and that is, some people say, well, prices are so low, there's going to be acreage come out of production. And you've got the variable cost on that low productivity at $278. Yeah. So basically, as long as a farmer can cover their $278 a bushel, if corn doesn't perpetually get below $278 a bushel, that the lowest productive land that, as you have as a category here, it's not going to come out of production.
That's right.
No.
So this is part of our agricultural problem. The overhead costs are pretty large, the variable costs are pretty low, and we keep farming most of those acres. Now there's some in the Dakotas and some in the western plains that would come out, but not in Indiana, or very likely land.
Another question comes out is, well, how can you possibly cash flow something like this? Well, the answer is you don't. But it is not as extreme as this appears, because somebody on low productivity land is probably not buying any machinery. And so from a cash flow standpoint, those costs are a little bit lower than what we have in the budget. Maybe they're getting a very low return for their labor for the next year or two, and so there is some reasons why we're still going to farm this low productivity ground, and it's going to come closer to cash flow than what we're reflecting here.
Good point.
Same
chart for soybeans,
yeah,
right?
beans are a very similar story, so I don't think we need to dwell on it, other than there's not quite as much difference between the break-even price and the soybean price for soybeans, particularly in the average and high, just reflecting the fact that our 2017 budgets are suggesting that soybeans are going to be more profitable on all three of these land productivity category classes than corn.
And let's take a look at that in more detail. You've done that.
This is looking at, let me explain this chart a little carefully here, because there's a lot going on here. What I've done is I've looked at the cost of production for rotation soybeans and continuous corn. And so that's the main comparison. It's not rotation corn, it's continuous corn. And so think of this as we have some corn acres in 2016. We're deciding what to put on those corn acres in 2017. We can look at continuous corn, or we can look at rotation soybeans. And so that's the comparison I'm making here. And so, for example, if we had a $10 soybean price, time we factor in the relative yields and the relative costs, looking at that middle column, average productivity soil, we would have to have corn price above $4.51 in order for us to favor continuous corn over rotation soybeans. That's rather alarming to people when you show that. It just illustrates how profitable soybeans are compared to continuous corn right now for Indiana. It's the same situations for Iowa and Illinois, but it's not as extreme. It would still be relatively high corn price required, but it wouldn't be as big as $4.51 in Illinois and Iowa, because their corn yields are a little stronger than what we see from an Indiana average.
Chris, we were talking about this earlier. Even if you drop those soybean prices all the way down to $8.50,
sort of the long run support,
you still need to see a corn price above $4 before continuous corn would pan out.
And again, I think this suggests that beans do have downside potential as we bring more acreage to soybeans around the world.
So the corollary to that would be, if you're thinking about expanding your soybean acreage because of these favorable returns, also think about managing the price risk associated with that increase in soybean
$10
production.
cash on the old or $10 cash on new crop should be looked at for forward pricing.
Well, let's think about some management decisions. And on our monthly surveys that we do with farmers across the nation, we ask them some questions about their practices and their plans for 2017. So we asked them what they plan to do with respect to fertilizer rates, seeding rates, and maybe some changes in their seed trait package. And this was back in the fall, in October. 46% of the people in our monthly survey said that they plan to use lower fertilizer rates this coming year. 19% of them said that they plan to lower their seeding rates, and 35% said they're going to make a change in their hybrid package. So farmers are looking at making changes. They're not just sitting on their hands and waiting for cash rental rates to adjust. They are attempting to make some management changes. If we think about that, I think that's really key going forward. Chris, we've got some projections for prices. You've got some history on here, as well as price projections for 16 and 17. And you've highlighted in yellow the peak year for each commodity, right?
Yeah, and that's back a few years ago, and basically the trend in prices, like grains, has been to the downside. In fact, record profitability back in 14 and 15 for various species here. But when we're looking at farm income, obviously the animal sector is also very important across the country. And what we see is the continued erosion of the cattle prices. So strong, maybe relative to some history prices, but substantial reductions on the cattle side. Calves probably getting back to levels that are, at least from our budgets, would be below break-even levels. Hogs, we're looking at $50 cost, so we have losses in 16 and 17. Dairy, $16 roughly cost of production in 16. A little bit of profitability for next year. And then the poultry, some ups and downs there, but generally seeing prices overall come down in relatively tight margins. So from the animal sector, we're not going to see a robust profitability. So this is going to keep overall farm income, along with the grains, pretty moderate in 17.
And as we think about what's taking place in the cattle markets, Chris, we've been in the midst of a pretty aggressive expansion of the herd. The prices we're looking at on that chart suggest expansion is probably going to come to a halt during 2017.
Right, so I think we're looking at a 3-year expansion, in which is, we normally think 5 to 6 years on a cow expansion for the beef cows. So I think it is going to be an extremely short expansion phase.
Yeah, when USDA releases its inventory numbers here in a few weeks, my guess is we'll still see an increase that showed up for 2016. Right. But looking ahead to 2017, I think we're going to put the brakes on that, because those prices are well below break-evens for virtually any operation here in certainly in the eastern half of the U.S. So let's talk a little bit about cost of production. Some of our costs have in fact gone down, but we're arguing that further reductions are needed. We've suggested that a target cost of production for corn should be $4 a bushel, or maybe a little bit less if you can push it down. Michael, I think you had on average productivity land, your total cost of production was about $4.40.
About $4.40, so another 30 to 40 cents needs to come out of that. We think that 1/2 may come from cash rent reductions, maybe another 5 to 10% coming here in the next couple of years, depending on where corn price lands. And so the big question mark there, or where does the other half come from? And that's going to depend on operation by operation, but we think kind of in aggregate, the two that need to take a close look at are probably fertilizer and seed. Large costs, and there probably is some adjustments that could be made with respect to those two to lower per bushel costs.
And it really is an idea of going back and fine-tuning your operation, and not just doing what you've been doing the last several years. And looking at each expenditure and asking the question, is this going to enhance productivity? Is it going to enhance yield? And if it's not, then think hard about why you're doing that.
But do that on a per bushel basis, so make sure you've got the yield impact included there. And there our target cost of production for soybeans, and we've got $10 on the slide here. Given Chris's earlier projections, we probably should change that to $9.50 to 10, because $9.50 might be a more realistic target as we move into 17.
Yeah, I think I would argue that you ought to be shooting for a cost of production below $10, and as far below 10 as you can get it, but certainly not above 10.
But the point is, a lot of people aren't at $10 yet. So
our budgets would suggest more like $10.75, $10.80. So those are some keys. Looking ahead, some key considerations. I think one of the things that people need to be thinking pretty hard about is the fact that looking ahead, 17 and 18, less program support coming out of the Ark County program for crop producers. We don't know what the program is going to be in 2019. This current farm bill covers through the 2018 crop, so we're not sure about 19, but clearly fewer dollars coming from the government side. Our budgets would suggest with trend yields, we're going to see some ongoing working capital drawdowns here in 2017 and 2018. As Chris illustrated with that slide earlier, that means net worth erosion is going to continue to come down, pull down that working capital, and that's going to come out of net worth.
And again, land values, important underlying asset for the farm sector, but those brood cows aren't worth what they were a year ago. The breeding herd is hogs are not worth. So several areas where we're seeing asset erosion.
If we go back to the the 2007-2013 period, net worth grew because strong retained earnings coming from strong profits, but also increase in land values. Now we're the exact opposite. Just elaborating on what Chris said, we've got low retained earnings. In fact, we have losses, and so that's a negative. That's coming out of net worth. Trying to scramble to meet cash flow, but we've also got declining land values, and so it's kind of a double whammy for net worth in the current period.
So, we don't know of any silver bullets out there. It really is a function of looking at every aspect of your operation. And Michael, as you've pointed out, there's a lot of variability across operations.
Yes.
So on different operations, it could be different aspects of the operation where you have an opportunity to reduce production costs.
I guarantee you, looking at some of the information, Illinois, Kansas, Minnesota, the different farm management associations, two items that we really haven't focused on very much here, labor and machinery, are extremely variable across farms. And so there's some farms that need to look at labor really closely. Maybe they have too much labor for their current operation. Maybe they need to be more efficient with the use of labor, but also machinery. The machinery investment per acre varies widely across farms, and there's some farms that are going to have to make some decisions on machinery, downsizing.
So some management strategies, what can we do? Chris, you've thought about this quite a bit.
Well, and actually we've used this the last couple of years, and it's pretty basic, and I think most are following these practices. Obviously looking very closely at capital purchases in terms of new machinery, new grain bins, etc. Working on family living expenses. We can't cut them enormously, but doing what we can to work on family living expenses. Looking for any excess assets that maybe could be converted into cash in the family situation. Lower cost per bushel, with a lot of emphasis both of you have made on that. Any farm-related income that we can increase. Off-farm income, of course, farm families know about that. Pursue, reduce cash rents. The safety net programs are important, particularly crop insurance and government payments, so keep up with those. And then work with your lender. This is, we're saying, not just for the next year, for the 17, but I was talking with one of the major business dailies yesterday and saying, I think you want to think this through the end of this decade. That's about what we're projecting, that there's going to be some negatives on out in at least to 2019. So with your banker, maybe let's look at 17. If things don't improve, what do we do in 18 and 19?
And I don't think we can emphasize too much the need to work with your lender.
Absolutely.
And this
for
kind
most
of
farm families, that's going to help them bridge this gap we're going through.
Yeah, and so it's a function of working with that lender and putting together a plan. And I like your point at the end there, Chris. Have a one-year plan, how I'm going to manage through 2017, but also think about that multi-year plan. So with that, I think we'll wrap it up. Our next webinar is going to be on the 20th of January. We're going to think about farm business strategy, and really from a little longer term perspective maybe than what we did today. So I hope you can join us for that. As always, we've got a wealth of information available on the Center for Commercial Ag site. I've got that address up on the screen. And of course our Ag Barometer site. And we'll have a new Ag Barometer coming out here the second week of January. So with that, thank you for joining us, and we'll look forward to seeing you on a future webinar.